Let me welcome you all to this policy event organized by the Chair Banque de France, which is the partnership through which the bank kindly sponsors activities in macroeconomics here at the Paris School of Economics. The topic of today's panel discussion is the policy mix, or the right coordination of fiscal and monetary policy in Europe. And the occasion for this is the recent publication of the 23rd Geneva Report on the world economy on this topic. And that report is entitled, "It's All in the Mix, How Monetary and Fiscal Policy Can Work or Fail Together." And I'm very happy to welcome three of the authors of that report today in order to discuss with three other specialists on the topic lessons and ideas for the policy mix in Europe in the wake of the COVID-19 pandemic. Now, I think it's fair to say that 15 or so years ago, the policy mix would have been a strange topic for such an event, and it would not have drawn the audience that we currently have. I can't quite see how many we are. 15 years ago, we thought we had found the holy grail of policy coordination, according to which independent inflation targeting central banks should manipulate short-term nominal interest rates to stabilize demand, while governments, on the other hand, let automatic stabilizers do their work and ensure fiscal sustainability. Now, as we know, the practicalities of this weren't always that easy, particularly in Europe. But even the Holy Grail theory was very quickly shattered to pieces. The financial crisis and the Great Recession that followed lowered nominal interest rates to zero and thereby deprived monetary policy of its main traditional instrument. Only a couple of years later, the European debt crisis showed us, in turn, how fragile the fiscal situation of countries with substantial debt levels can be when financial market sentiment changes. True, non-conventional monetary policy was surprisingly effective in the 10 years that followed in keeping economies afloat. But now, the COVID-19 pandemic has further tightened the constraints on monetary policy and fiscal policy by inflating public debt and destroying any prospect of normalizing monetary conditions soon. In today's panel, I'm excited to welcome six eminent economists who will discuss how monetary and fiscal policy can get us out of this mess, or more generally, how they can work together to bring us back to sustained growth in Europe. Specifically, I'm happy to welcome Elga Bartsch, Head of Economic and Market Research at BlackRock, Agnès Bénassy, who is my colleague here at the Paris School of Economics, although right now she has an arguably more exciting job as the chief economist at the French Treasury, and Giancarlo Corsetti, professor at Cambridge University. Together with Xavier Debrun, these are the co-authors of the report, the Geneva Report I had alluded to earlier. And I'm excited that they will be joined by three other economists who are specialists on this topic, namely Olivier Garnier, who is the head of research, statistics, and international at the Banque de France, Dirk Niepelt, who is the head of, or the director, I should say, of the study center Gerzensee, but also a professor at the University of Bern, and finally, Charles Wyplosz, who is professor emeritus at the Institute for Advanced Studies in Geneva. We will start with a brief presentation of the report and its lessons for Europe, followed by introductory comments and remarks by our three other panelists, and then there'll be a panel discussion. And we'll move to a Q&A session with the audience after that. Before we start, let me say a couple of words about online etiquette. The audience microphones will remain muted during the presentation, the comments, and the panel discussion. But you can ask questions in the chat at all times. Also, there will be an open mic Q&A after that, but I would ask you to announce any questions you have for this in the chat to make it as formal as possible, but not chaotic. I should also say, should my internet connection go down or you can't hear me, as it was previously a problem, Agnès, who is my predecessor here at the Chair Banque de France, kindly agreed to chair the meeting for me. And now, without much further ado, let me give the floor to Elga, who will present the 23rd Geneva Report on the world economy entitled "It's All in the Mix, How Monetary Policy Can Work or Fail Together."
So apologies, but let me get started by, first of all, thanking the Paris School of Economics, the Banque de France, Tobias, as well as Dirk, Olivier, and Charles for agreeing to discuss our work. And on a personal note, I also want to thank my co-authors, not just helping me out with technical issues on the spot, but more importantly, for really collaborative, productive and enriching work that we've been able to do over the last year. Because clearly when we started to work on the report, it wasn't clear at all how important this question of the policy mix would become. It was not clear what a massive leap in terms of coordination of monetary and fiscal policy we would see. And it seems to me that the debate on the policy mix between monetary and fiscal policy still is gaining intensity, and that views are still evolving, nowhere more so than here in Europe, where we have really seen a very profound policy revolution. So what I was planning to do is to do a quick setting of the scene in which I outline our take of the history of economic thinking and our summary of the empirical evidence, and then devote the bulk of the discussion on the role of tail events, which we think are crucial to understand how monetary and fiscal policy should be working together. Then quickly take you through some examples of monetary and fiscal coordination, and then draw some preliminary policy conclusions. And like many of my co-authors, I'm speaking on these matters in a personal capacity. But so for many years, we've really taken it for granted that monetary policy was the main instrument to stabilize the business cycle, to steer inflation. But it's now clear that we need to rethink that long-standing paradigm. Fiscal policy needs to play a more active role. And we have seen an ad hoc coordination between the two forced by COVID-19, but that should be replaced by a more deliberate discussion of the institutional framework guiding both monetary and fiscal policies. And given that central banks, including the ECB, are currently reviewing their policy frameworks, it's interesting to see that fiscal authorities also are starting to have a similar discussion, especially around the principles guiding fiscal policy in the euro area. Because in our mind, there's no doubt the policy mix is back on the agenda. And it's not just in those circumstances where monetary policy is constrained at the zero lower bound, but also in the future where fiscal policy could potentially be challenged by what currently are rapidly rising levels of public debt. And interestingly, for the report, we really had to go back to the classics and review their thinking of the policy mix long before the strict separation between the two, monetary and fiscal, became the sort of broad consensus. We also, after sort of diving back into the classics, we took a look at the evidence for the OECD countries since the mid-80s and to see how the mix was actually implemented in practice. And there are also a number of key findings. But let's start really with the classics. And we sort of went all the way back to Tinbergen and his principle, Tobin, Okun, and but also the more recent literature. But we had ended up with one specific question in mind, that of tail risks, either because of large exogenous shocks such as COVID-19, but also those tail risks that are arising from seemingly moderate shocks that grow larger and larger over time because of an insufficient policy response. And especially Okun was very instructive in telling us about sort of the preservation of the effectiveness of policy instruments and how the policy mix can either be enhancing or hampering the overall policy space for demand stabilization, not just now, but also in the future. And so one thing that became a key takeaway for us was really the saying that Okun coined, which is that the policy mix should remain in the middle of the road. So, and that's sort of where we found the ideas of sort of looking at the two instruments, and I think we might want to go further one slide if possible, to basically to think about them in terms of strategic substitutes or strategic complements. And in particular in the sort of so-called funnel model, where you can imagine monetary and fiscal policies being two taps that can fill the funnel of aggregate demand. And they cannot sort of separately determine the level of prices and economic activities, only the product of the two, nominal GDP. And it's totally fine if different combinations of M and F, monetary and fiscal, can sustain a certain level of aggregate demand. If one falters, the other can substitute for it. But that's no longer the situation we are currently in, because we do have some sort of insufficient policy space. So this funnel model only works if there is sufficient policy space for either of the instruments to stabilize demand. Okun stressed that a good policy mix really depends on the credibility of an effective countercyclical policy being available in the future. So it's very much sort of working also through the expectations channel. And a good policy mix should be using all the available policy space. But at the current juncture, we're looking at a situation where policy space seems to become scarcer and isn't, at least with just one funnel, sufficient to sustain a large shock. And so that's sort of also what we realized when we dissected the evidence since the late 80s, which was very much at the odds of the prescription of the classics. So we hardly sort of find a congruent policy mix of simultaneously countercyclical policies, and most often actually they pull into different directions. So monetary policy into one, fiscal policy into the other. And sometimes this is, of course, for good reasons. You might have a supply shock, you might have financial shocks, so that you need to sort of work in both of them in opposite direction. But this happened way too frequently across OECD countries. And so we found sort of a very high frequency of divergent and often also destabilizing policy mixes. And one explanation for that could be that fiscal policy was often hampered by political factors, in some cases by debt constraints that really followed governments to follow sort of the right policy principles. We also felt that important lessons can be drawn from crisis episodes. In sort of interpreting the current policy mix, the first observation is that even though policy rates are at their lower bound at the moment, monetary policy is actually far from ineffective. In fact, in crisis years, the policy mix has often been congruent, and that is our sort of second key observation from the empirical analysis, is that sort of unconventional measures in monetary policy blur the distinction between monetary and fiscal policy, and because the low borrowing costs help to improve debt sustainability, but also potentially could hamper its adequate assessment. So in our view, the policy mix always needs to be understood in the context of these tail risks, because they challenge the standard mix, especially at the zero lower bound. And again, this can happen. This constraint can happen from large exogenous shocks, but it can also endogenously develop from small disturbances. And that's sort of then somewhat more problematic. Now, in the period after the global financial crisis, we had some encouraging example of a stabilizing policy mix, monetary policies to a large extent managed to escape the liquidity trap, the trap of becoming powerless by resorting to a wide range of unconventional policies. But the policy mix can only be congruent and effective when monetary and fiscal policy create policy space for each other. So the central banks need to ensure that borrowing costs remain low and that there is an effective monetary guarantee on the nominal value of government bonds, which allows governments to borrow without fearing any sort of debt belief-driven market dislocations. Equally, fiscal authorities need to safeguard monetary policy space by backstopping the central bank balance sheet and committing to potential losses, to cover potential losses. And this is important to prevent runaway inflation expectations should a central bank move into negative equity. And so this is a very powerful interdependence between the two, but really working it requires some a nimble approach. And importantly, it requires to be more open-minded about the need for coordination between fiscal authorities and central banks. And it also requires a strong institutional framework, a framework that equally backs the credible long-term commitment to price stability, but also to debt sustainability. And because without a solid institutional framework, the monetary fiscal coordination can go wrong. It typically goes wrong for two reasons. One is the example of the euro crisis. This happens when governments fear to navigate the interdependence and embark on a wrong divergent policy mix. So that's sort of the early onset of austerity during the global financial crisis would be an example of that, which is what happened in Europe, or alternatively, because governments fail to understand the limits of the interdependence and sort of stretch balance sheets beyond their breaking points, such as, for instance, in the example of Argentina. A milder, more implicit form of policy coordination would be yield curve control. And that is something that is an interesting sort of historical episode to study, both in the US and the UK after the Second World War. And in particular, the experience of the US is very instructive because it points to the risk of exiting the coordination too late, i.e. only after inflation has become a problem and only after an open conflict about central bank independence has broke out. So this could potentially be rather disruptive for financial markets. And as a result, is maybe something that on occasion you cannot avoid, but to have a deliberate framework around this would be preferred. So where does that leave us in terms of the policy conclusion? In the report, we spent a little bit of time to discuss how to increase the equilibrium interest rate, which is at the heart of the problem, and we argue that we should look at this as a global public good and work towards a global initiative. But instead of sort of discussing this in more detail, I just want to sort of talk a little bit about sort of how we get back to the middle of the road again. Because in particular in Europe, there are a couple of aspects that are important. So clearly we are in uncharted territory, and we sort of are in a situation where we will have policy constraints on both sides, which means that monetary and fiscal policy will need to work much more closely together. It's already clear that monetary policy is constrained by low levels of R*, low level of inflation expectations, and in future fiscal policy could also become constrained as well due to rising debt levels, which currently nobody seems to be particularly concerned about, but this of course could change. So, which is why it's so important to have credible commitments to the long-term goals, both sort of in terms of strong and balanced growth in the euro area, price stability, but also debt sustainability. Only if you have those as sort of the cornerstones of your institutional arrangements, you will be able to define an effective policy mix. And for the euro area, this also sort of includes the completion of monetary union, probably the creation of a permanent fiscal facility, importantly, a common safe assets, and alongside the ECB strategy review, another review of the European fiscal rules with a view to simplify the two-pack, the six-pack, and maybe also take a look at the macroeconomic imbalance procedure. With that, let me thank you and sort of hand it to our discussants. Thank you, Agnès.
Yes, and we take the discussions in strict alphabetical order, so let me pass the word on to Olivier Garnier.
Thank you, and good afternoon to everybody. And I'm very pleased to participate to this panel, which is co-organized by Banque de France and PSE. So, of course, I will discuss the Geneva Report, which is very timely and very welcome, since it discusses one of the most important current policy issue against a backdrop of very low inflation and interest rates. The question is how to deal with the policy trade-off resulting from the combination of high government debt levels, ballooning central banks' balance sheets, with a strong link between the two, since a substantial part of government bonds are held by central banks. So I will just make 3 comments. Of course, this is the rule of the game. I will focus on the points maybe which I found the more debatable in the report. First, my first comment is that if central banks remain rightly committed to a monetary policy regime of inflation targeting, then the difference between government bonds and central bank money, indeed the reserves, should not be oversold from the standpoint of long-term sustainability. So why do I say that? Just because, as you know, under an inflation targeting regime, central banks need to pay interest on reserves, or equivalently to issue a remunerated certificate of deposits, in order to keep control of short-term interest rates and ultimately of inflation. And so from the perspective of the consolidated balance sheet of the government and the central bank, treasury bonds and reserves are therefore very similar, although with some differences. Bonds have a fixed maturity, unlike reserves, and the interest rates on bonds is generally fixed, while the interest rate on reserves is variable and directly linked to monetary policy decisions. In other words, central banks' purchases of public debt change the risk structure of the liabilities of the consolidated government by swapping reserves against bonds, but not their overall size and their long-term cost. They reduce the liquidity risk for the government, but they shorten the effective maturity of its liabilities and make them more sensitive to interest rate changes. In particular, it means that it might be ineffective for the state to issue very long-dated bonds or even perpetual bonds if a substantial share of them is ultimately purchased by the central bank. Despite the fact that we see, I'm not saying that the report is saying that, but many people are saying the state should issue very long-term bonds and then the central bank should purchase them, but this would be rather the opposite result. My second comment is about coordination. No, my second comment is about R-star. In my view, it's debatable whether a rise in R-star should be considered as a public good and whether the fiscal monetary policy mix is the appropriate tool to raise R-star. Of course, a low R-star is a challenge for monetary policy, but this is not the case for fiscal policy because it's quite the opposite. For fiscal policy, it may improve fiscal sustainability if the interest rate is below the growth rate of the economy, and it may also enhance the size of fiscal multipliers, since we know that multipliers are higher at the lower bound. From a public policy standpoint, what has to be fixed is not the level of R-star per se, but the factors behind its low level, if they have economic or social costs, for instance, lower productivity growth or wider inequality. So the primary policy tool to tackle the cause of a low R-star should be rather structural policies rather than the policy mix. And the report suggests that a fiscal expansion backed by temporary monetization could raise R-star. It's not clear for me why, because temporary monetization would, I don't see why temporary monetization would help, since R-star is a real interest rate. And more important than the financing, bonds versus money, is the quality of public spending, whether or not public spending enhance the future productivity of labor, for instance, through education spending, or the productivity of capital with infrastructures, research, innovation, and so on. The fact that the risk-free interest rate is very low and below G, the growth rate of the economy, doesn't imply that there is too much savings, and the return on capital has much less fallen. We know that, according to many studies, the return on capital or the return on equity has remained much above the growth rate of the economy. So the key question is the key issue, policy issue, is more about the saving structure with an excessive demand for safe assets. So before increasing the supply of safe assets through higher public spending, we should consider how to foster the demand for risky assets. And in the European case, I think we tax structure, both for households and corporates, pension system, capital market union to enhance cross-border private risk sharing, and also how maybe we could increase private and public risk sharing for long-term risky investment. My last comment is about the complementarity between monetary and fiscal policy. I fully agree that in the current environment of low interest and inflation rates, monetary and fiscal policies are congruent and complementary. However, this doesn't imply that coordination between the two policies should become the new normal regime. Indeed, the key challenge facing governments and central banks is not how to dance to the same beat with the current music, but how to part away when the music stops. So let me just to be a little bit more specific on that. As long as inflation prospects are too low with respect to central bank's inflation objective, of course, monetary and fiscal policy can be congruent but then without any formal coordination. So the key challenge will be when the central bank eventually needs to exit from its current policy stance by tapering its asset purchases and raising its key interest rates. There should be no doubt that the central bank will not be submitted to fiscal dominance. That means that the central bank will continue to take its decision in full independence and according to its price stability mandate. If not, the current sweet spot of congruence would be short-lived. And the best way to prevent the risk of future fiscal dominance, which would be highly counterproductive even far before it materializes through expectations, and to ensure the congruence of the policy mix, is not to negotiate an arrangement between the central bank and the government, even if the central bank were given the upper hand in triggering the exit process, as it is sometimes suggested. In my view, it's much better that monetary policy and fiscal policies remain fully independent, but with clear and credible reaction functions for each of them. For the central bank, it's very, I think there is no debate. It's the mandate, the inflation objective, and the forward guidance. Of course, it's more complex for governments. In the case of governments, I do not believe that forward guidance only could be sufficient because there would be then a problem of credibility and time inconsistency. I think what would be more appropriate in the European case is first to reform the Stability and Growth Pact with fiscal rules anchoring the long-term public debt trajectory. So there is currently a debate on sustainability criteria for fiscal rules in a low-rate environment. For instance, should we look at the debt to GDP ratio or to the interest payments as a share of GDP? Maybe, I would say, maybe in my view, what could be done is to get back to deficit criteria, because when you have a kind of deficit ceiling, then what you introduce is a kind of feedback mechanism from interest payments to the primary balance. And this could be implemented through some form of expenditure rule as proposed by the European Fiscal Board. But in this expenditure rule, I would not take into account the primary expenditures, but expenditures including interest payments to get this feedback mechanism. Another area to explore would be to enhance automatic stabilizers by establishing more automatic contingent policies, for instance, for the exit from exceptional fiscal measures such as furlough schemes. And then, this is the idea of semi-automatic stabilizers à la Blanchard-Summers. And last but not least, establish a permanent common fiscal capacity to address large shocks in the euro area. The next generation EU package is a welcome first step, but of course, it's very important that its funds are deployed for productive spending and accompanied by growth enhancing reforms. So this was my 3 comments, and so the floor is yours.
Thank you very much, Olivier. And let us go straight to the next discussant, Dirk Niepelt. Please, the floor is yours.
Thank you very much.
Dirk has some slides to share, so please go ahead with that. It might take a minute or so.
Thank you very much, Tobias. Thanks very much to the organizers and to the authors.
We can see your slides well.
You can see them, and they actually move.
Not on my screen. Yes, they do move, yes.
They do move. Okay, so that's just great news. Thank you very much to the organizers. Thanks for having me. And thank you very much to the authors, of course, of what I think is a very rich and a very insightful report. I'd like to structure my comments around 4 main themes. And as you'll see, I think there's quite a bit of overlap with what we just heard from Olivier without having been able to coordinate with him. It turns out we have quite similar views on some of the issues. So the 4 themes I'd like to raise are first the focus of the report, then the policy implications in terms of institutional change, then a few remarks on the measurements, on the empirics, and finally how all this relates to a couple of policy debates that we currently observe going on. Let me start with the focus. So this is a report that very heavily focuses on aggregate demand management issues, has a perspective on aggregate demand management. Of course, economic policy is much more than that. I loved how they started from from going back to the classics. Now, if you had asked me what are the classics for that kind of questions, I would probably have listed people like Pigou, Ramsey, Samuelson, Diamond, Malise. And then, of course, there's all these caveats to what optimal policy could do or what it cannot do because of Kidd and Prescott and all the public choice people. Now, of course, the authors know about that, right? They know, of course, that economic policy is much more than aggregate demand management, and they are clear at the outset that they want to focus on aggregate demand. Why do I still want to raise the issue? Because I think there's a little bit of a danger by adopting this aggregate demand glasses and then, arguing about different topics from that perspective. One relates, for example, to COVID-19. There's quite a bit of discussion in the report about how this affects the current policy mix or how it should affect it. In my view, if you come from the aggregate demand perspective, you are too quickly led into arguing that this needs some aggregate demand management in current times. I would disagree here. I would think that the main policy issues in COVID-19 are externalities, public goods, redistribution, maybe bridge financing, certainly not first order aggregate demand management. Of course, we have very low aggregate demand right now, and we have many other problems, but we don't have first order problems of the type of distorted aggregate demand, right? Low aggregate demand doesn't mean distorted aggregate demand. Another reason why I think this perspective, this aggregate demand focused perspective can be dangerous is that in the end, what all this is about institutions, right? How should we structure institutions? And institutions should not be the right ones only to deal with aggregate demand frictions. They should be much more broadly the right ones to deal with a whole set of potential economic policy issues. It should be robust institutions from that perspective. And one example, just to clarify this, is, for example, the current debate about, should monetary policy be involved in conducting climate policies, right? And that's clearly a question out of the aggregate demand realm, but clearly a question that needs to be addressed, and that should be already also related to the bigger questions of what are the right institutions for economic policy. Now, the second theme, or the second topic that I would like to raise, is the one of, okay, so what is there now for us to do? I think in the end, we want to understand, is there a need for institutional change, given what the authors convincingly argue? And what they do argue in the report is, on the one hand, that we need complementarity, we need to exploit complementarity, so we need to move from what I find very nice, from this monetary plus fiscal to monetary times fiscal, this complementarity sense. But at the same time, they argue convincingly, I think, that we need credibility, right? Expectations need to be anchored in order to exploit these complementarities. Now, what is the status quo compared to that? The status quo is one in which clearly we do constrain coordination. The two main fiscal and monetary policy authorities are subject to constraints. Perfect coordination is not possible. And of course, the logic behind all that is that it's probably better to have some second best arrangement in which we impose some constraints rather than having the options or the dreams of first best policy coordination, which typically doesn't work out, and we end up in some third best fiasco. So the question in the end then to me is really, do we need to change the status quo, or is the status quo sort of the best that we can achieve in a very broad setting in which we need to account for the fact that this status quo arrangement needs to be able not only to account for aggregate demand management, but for many other economic policy questions. And some key guiding questions in that context to answer that question are probably, do monetary and fiscal policymakers have the right incentives, given this institutional arrangement, to deliver? Do they have the capabilities to deliver, or don't they? If they don't, does it take more rules? Does it take less rules? Does it take more automatic stabilizers on the fiscal side, for example? Do we need more national rules, more international constraints? These are, I think, the key questions that we need to address if we want to conclude in terms of whether the institutional arrangement needs changes or maybe it doesn't. My third point relates to the question of measurement, so the empirical work. What the report does is that it analyzes policy impulses and how they are correlated, whether we have pro-cyclical, counter-cyclical, complementary, congruent action. And mostly the focus here is on the primary surplus on the one hand and short-term interest rates on the other, which is the natural, of course, choice if you want to look at of the major policy instruments. All I want to do here is to highlight that, of course, there's much more, right? I mean, if you would like to get a more comprehensive picture of what the policy impulses are, there's many other things. And I would like to raise two issues which are maybe not as often considered, of course, but at the same time, they're well understood. So one relates to what I call here the implicit deficits. What I mean with that, what I mean with this is changes in implicit liabilities. For example, changes in social security regulation, which doesn't have any budgetary impact today, but of course has major implications on how households perceive their fiscal or their wealth situation change over time, and therefore potentially affecting responses in the private sector. Another quite important effect actually is the interest rate structure. So in a very recent paper of mine that came out at CPR just for a few weeks ago, what I look at is what the implicit subsidies to banks are, the bank profits generated by the interest rate structure. If you look at the US, what you find is that changes in the interest rate on reserves and how these changes correlate with the risk-free interest rate and the interest rates on deposits have implications on bank profits, which are on the order of 0.5% of GDP. So just before the Great Recession, towards 2 or 3 years after the Great Recession, this actually triggered a fiscal impulse, if you want, on the banking sector on the order of minus 0.8% of GDP. So a contractionary impulse through the banking sector. This is a huge effect, but something that you would, of course, typically not measure if you look at the standard instruments. So in the end, what does this leave us with? Of course, in the end, and that's exactly what Olivier, I think, just said a minute ago, in the end, what we would like to understand is the consolidated government's budget constraint or the consolidated government balance sheet and how it affects the private sector. And this is super hard to measure in general, but of course, we have to keep this in mind that there's much more than those two primary fiscal impulses. Finally, a word on the current policy debate. The report alludes to various policy discussions without necessarily endorsing those. Let me just raise 4 or 5 points here, which I think are closely related to what the general message of the report is. One is one that actually also Olivier, I think, just took up a minute ago. The fact that we have a low R star doesn't mean that we have an inefficiently low R star. So the fact that R star is low doesn't necessarily imply that we should, have some policy responses to them and that they should be on the aggregate demand side. Also, I didn't understand the link between R star, if it's real, and monetization, exactly the point that Olivier raised before. Discussion about helicopter drops. I think it's obvious for economists, but it's not at all obvious for many people who write about that. The current institutional arrangement without problems allows for equivalent things like helicopter drops. If you have a debt finance transfer by the fiscal authorities and then a permanent QE following that, you have exactly the same as a helicopter drop. What you also read a lot about in the public discussion is that Olivier Blanchard in that case, told us basically that we can, without any cost, issue public debt, and we should do this and invest in public investment. That's how the press typically takes up the presidential address of Olivier Blanchard. Of course, that's not what he said, right? I mean, what Olivier did in his paper is that he looked at what are the effects of essentially pay-as-you-go financed social security. To what extent does this have positive and negative implications? He's, I think, pretty clear about the fact that in most situations, this would not necessarily involve Pareto improvements, but it would benefit some and hurt some other people. It has nothing to do with public investment. It's about intergenerational redistribution. And of course, as economists, we know that pay-as-you-go funded social security is isomorphic to public debt in some dimensions, but the public interpretation of this result is, I think, very much at odds with what the literature actually suggests. There's another theme that you frequently read in the news or in the press, which is that we have low real interest rates and therefore we should have much more public investment. This seems obvious, but it's not true, right? If you write down a Ramsey model, you will find that the real interest rate is related to the slope of public debt, not necessarily to the level of investment. Public investment depends on the one hand on the real interest rate, and on the other, if you conduct policy optimally, on the shadow value of public funds. So there's many reasons to believe that this has changed in recent years. So as long as you take this out of the picture, the mapping between real interest rates and public investment is less clear than what is often suggested. Final point, and I find this a very nice point in the report, this two-way support, fiscal policy supporting monetary policy, backing monetary policy, but monetary policy at the same time backing the fiscal policy. And I think it's a very valid point. But of course, if you follow the public discussion, even in the country where I work, which is Switzerland, where you think that monetary policy is sort of super independent and whatever, what you see in the public discussion is, of course, always a one-sided discussion, right? There's never discussion about the fiscal authorities re-establishing equity for the monetary authority. It's always the other way around. When do we get the central bank profits, and why don't we get them today rather than in the future? So all of this leads back to a recurrent theme of public choice, political economics that the authors discuss and are, of course, very well aware of. But let me end with that. Thank you very much for an exciting report and for having me. Thanks.
Thanks, Dirk, for your comments. Let's move straight to Charles Wyplosz for his, as we are running a little bit late. I believe Charles also has some slides to share.
Yes, thank you very much. I understand it takes a little bit of time. Please let me know when you see them on your screen. Meanwhile, I want to thank the organizer to invite me to discuss this paper. It is a very interesting paper, and it prompted a lot of thinking on my side. I still don't see the slides.
Let us give it another 10 seconds or so. Otherwise, I suggest you stop there. We see your desktop now.
Yeah.
Maybe that's your back lawn, in which case I'm very jealous.
No, I've put the slides on. Do you see them now?
No, I still see a lush back lawn. Yes, now we see it. Perfect. Thank you.
Okay. Okay. So thanks a lot. Let me try to improve. All right. So first, I think summarizing this paper, this report, it makes two innovative contributions. As Tobias said at the outset, you would think that any discussion on policy coordination would be boring and useless, and yet the authors should be congratulated for having bring a new view on that, and I find that pretty impressive. Now, my very short summary of what they say is that monetary and fiscal policy should be strategic complements in what they call a tail risk situation, which is when both policy spaces are limited. So interest rates are zero or negative at the effective lower bounds, and fiscal policy are blocked by very large debts. So there's nothing much they can do. And surprisingly, perhaps, the authors tell us that no, if they work together, they can increase each other's perceived limited space. And the second point is that exit tail risk can be reduced by going to the middle of the road. So by having policies that are less cornered than they have been. I think this sounds extremely clear and ex post obvious. It wasn't obvious ex post, and I love this report for that. Now, where does it come from? Well, it comes from old principles. So we had Tobin and Oken and the whole Yale school coming back, not really completely surprisingly, but it's been re-engineered to current times and very, very smartly through. So it leaves you with a new view on policy coordination between money and of course, when you get into this new idea, there are a number of issues that are raised. I will essentially focus my short, brief remark on three issues. First, why did we get stuck in such a tail risk situation? Two, can we expect fiscal policy to do right its share of complementarity? And three, should the monetary policy continue to carry the world as it's been the case for the last decade or so? Now, why are we stuck in this tail risk situation? The obvious answer is, well, we have shocks, although not all shocks are exogenous. The current COVID shock is certainly exogenous, at least for economics. But the 2007-8 crisis was not exogenous at all. It was the result of serious policy mistakes. So the first little caveat here is that when we talk about shocks, we may think harder about how to avoid the shocks. But that was the literature over the last 10 years after the global financial crisis. 2, there is this low R star. Now, the usual explanation we are given for currently low interest rates, which are interpreted as implying a low R star, are structural causes: saving glut, demography, productivity, inequality. I mean, there are countless number of papers that argue for that. There is another interpretation which is less often mentioned. I think Claudio Borio at DBS has been pushing that, which is if you keep interest rates very low for very long, I put far too long, and you flatten the yield curve, then what you get when you do empirical work, you find a very low R star. And R star, what we see is very low interest rates, which doesn't mean low R stars, but, and here I'm disagreeing with Dirk, I think we have had expectations of demand depressed for a long time. So that combined with very low interest rate all the way up the yield curve suggests to me that that's what guides the estimates of low R star. If that's the case, the problem of low R star is monetary policy, not structural causes, or I should say not only structural causes. And it's a multiple equilibrium story where central bank push interest rate down forever. Demand is not growing, and it feeds onto itself. That's just to mention to have one comment. Now, what that also say is, the last decade, very active monetary policies substituting for inactive fiscal policies. And that was the case before we got into a Taylor situation. We didn't have policy substitution, we didn't have policy complementarity, we just had wrong policies that took us in the current situation. And that's a message that it's of course extremely important to discuss how to get out of the current situation, but it's extremely important to discuss what we do in the future and not to get stuck in this situation. I'll get back to that. Now, second point I want to raise is we can expect fiscal policy to do it right. So the story we have here is that fiscal and monetary policies should coordinate and be made to work complementarily. I can trust central banks for doing that if they wish to do that. And there were the previous interventions by Olivier and Dirk put questions where they should even think to do it. But assuming that central bank want to do that, they can do it. They are fast, they are flexible, they can adjust their policies very quickly. Now, fiscal policy is very dubious. Fiscal policies have a poor track record, and the report documents fiscal policies being mainly pro-cyclical. If we look at the last crisis, and it was already mentioned by Elga, fiscal policies were good for a couple of years. Then there was this premature withdrawal, which in Europe created the second dip. Now, a key reason, I think, fiscal policy is going wrong, especially in the situation of tail risk, is that there is fear of indebtedness among governments. Now, I think the constraint on the debt is poorly understood in general and among policymakers. Part of the reason why governments make mistakes is political reasons, but also what Eric Lipper called a decade ago the alchemy of a fiscal policy as opposed to the science of monetary policy. And one aspect of that is for more than 20 years now in the monetary union, for a century in the US, states and other places, fiscal policy has been constrained by rules that are very poorly designed. And I'll come back on that. Well, let me just say the next thing. What we need is governments guided, not constrained as fiscal rules are often defined, but guided by fiscal rules. So here again, I'm borrowing for Eric Lieber. There is a shining example of fiscal policies guided by proper rules, New Zealand. So New Zealand didn't get just COVID rights. They've been getting their fiscal policy rights for a long time. And I think this is urgent in the euro area if we want to avoid a premature withdrawal. And I'll get back to that. Now, should monetary policy continue to carry the world? Well, there's no discussion. Central banks have saved the world with their very active monetary policies, the new instrument and all that, until they became stuck. They have been inventing more instruments, but these instruments are not effective enough to do the job. Low for long interest rates are now at their effective lower bounds, and there's nothing much they can do. Still, we have inflation that's bordering on deflation, certainly in Europe and elsewhere. They have done balance sheet expansions. Now, if we move away from the Yale School and we go to the Chicago School, we should have seen runaway inflation, and a number of people have predicted runaway inflation. Didn't happen. Actually, all these policies have been unable to raise inflation over the last few years. Finally, central banks have been involved in macroprudential. That's very good. It's an important additional instrument, but it's not monetary policy. It's regulation policy. Central banks do it in some cases because policymakers thought the central banks are smarter, and that's fine with me, but it's not monetary policy proper. This policy of very low interest rates have encouraged inactive fiscal policies. Why should government do anything hard like smart fiscal policy if the central banks are here to keep the economy growing and hopefully keep inflation at the targets? And the amazing thing is that fiscal policies have remained inactive even when the real interest rates was less than the growth rate, in which case, and here I disagree a bit with Dirk, the message from Blanchard and others is that when the interest rate is lower than the growth rate, you can have deficits forever without increasing the public debt, with which I strongly disagree. But governments didn't go into this kind of thinking because they didn't feel the need. Now, can central banks stop being super active while governments are falling asleep? I don't know. That's an important question. It's not dealt with in the report because the report doesn't ask that question, but it would call for mandates, central bank mandates, to be reinterpreted. And I heard Olivier being very reluctant to go in this direction, and I understand that. If central banks just do what they think they should do, irrespective of what governments do or don't do, then we could have a case of monetary dominance, and there is a fear that would be a threat to independence, and that's what my interpretation, what Olivier was saying a little bit earlier. Now, let me just say a few things about the particular case of the euro area. The idea of coordination in the euro area is mind-bogglingly complicated because of the institution. We have one central bank and 19 governments. There is no mechanism for coordination between the ECB and the governments taken together, and even among the 19 governments. So we have this new next generation EU, which is a sort of coordination among governments, but it's such a rigid bureaucratic enterprise that we don't know if it will ever function, and certainly it has nothing of the flexibility that we would need if fiscal and monetary policy were playing together. So regrettably, this great symbolic initiative is not well designed. Another point is that there are different economic conditions in different countries, and each country is fiscally sovereign. So the incentives or the needs of individual governments differ. We saw that before the COVID crisis, Germany was booming and didn't have any other need for fiscal policy than to reduce the debt. In many Southern European countries, it was exactly the opposite situation. Getting an agreement among governments which have faced different incentives is basically hopeless. Finally, there is the question that was raised about, and it was discussed by Olivier. What happens if we have coordination? Coordination, when it's operational, it reduces the margin of action of players, and people, central bankers, are worried that this would reduce the independence of central banks. The ECB is formally independent, but it's also under political influence, and we've seen that during the European debt crisis. So this whole issue of coordination, while I entirely agree with the theoretical part of the analysis, it raises a number of issues. Now, I don't want to leave you with a negative point, so let me make two suggestions. We need to have fiscal policies that work, that are counter-cyclical, that are not hostage to all sorts of myths, and that's what the Growth Pact is doing. It has no economic theory backing, and I think we need to replace it with a good rule that is based on science, namely of what is debt sustainability, and not on 3%, 60% spending targets, and so on and so forth, which have no theoretical backing. And we have to do it fast because the Stability Pact that we suspended until the end of this year, January 1st, 2022, we may have to go back into the old pact, and that would be a hugely missed opportunity. Now, for the ECB to stop trying to save the world, I think complementarity, yes. When the ECB has offered backstop to public debt, both in 2012 and more recently with the COVID crisis, under the official name of balance sheet policy, the ECB has opened fiscal space to governments, so that's good. Now, substitutability, which means when governments don't do anything, central bank go into negative interest rates. I'm not a great fan of that. I note here simply that a year and a half ago, something like that, Sweden decided to exit its negative interest rates just because it felt uncomfortable there for good reasons, and nothing really happened. So that shows that monetary policy was inefficient, and as long as it's inefficient, it could have as well positive or at least zero interest rates. And I will stop my comments here. Thank you very much.
Thank you very much, Charles. We are severely out of time, and I would like to take some questions from the audience at the end. So can I ask the authors of the report to maybe take 5 to 10 minutes to reply to the points which I'm happy for them to choose? And perhaps we start with Agnès and Giancarlo, who haven't so far had the floor.
Many thanks to all three for your very nice discussion. Actually very rich. So it would deserve a very long talk to sort out all the arguments. So, but very briefly, perhaps on Olivier, I tend to agree with your point on inflation targeting, and this is the point of the report to make. Well, if you have an objective of, if you have a strategy of inflation targeting, how to make it consistent, even with tail risk. And this is all about our graph with the mutual fiscal or monetary space. On R star, I think the whole discussion, so maybe Giancarlo can discuss on this, the whole thing is that the distinction between R and R star. So there are various ways of R star, and it makes monetary more comfortable. It's all of the strategy of coming back to the middle of the road, actually. So, and I didn't really see the point about monetization. I don't think this is in the report to monetize in order to increase R star. So maybe we can come back to that bilaterally. I liked the comments by Dirk about the first best, second best, and this actually, in a sense, is what it's all about, the rules developed by Charles afterwards. I think that, well, when Charles said about procyclicality and about the poor track record of fiscal rules, I think it's mostly in the upside, actually. So it's not really related to the fear of indebtedness. Probably yes to poorly designed rules, and this is why many people have suggested having expenditure rules. So would you go in that direction? So what is a good science-based rule? This is the key issue, and how to make it still simple. Because I think as economists we have failed in introducing concepts such as the output gap and we are now stuck with the output gap, and after the crisis nobody will have any idea what is the output gap. Now maybe to finish with very quickly, so what I like the idea of designing the institutions or the rules or the combination of the two in order, so this was from Dirk, how to have both monetary and fiscal policy have the correct, how to get the incentives correct, so that then they can implement the second best. This would be fantastic, but can we just rely on rules, good rules, and automatic stabilizers? This is the key issue. And as Charles mentioned, a big complication in the euro area is that we have 19 governments. And so far there has never been, well, except with the next generation EU, which still needs to be confirmed, there has not been any attempt for coordination. It's only about discipline, and what we are dying with is the lack of. So I understand that if we could have perhaps much more powerful automatic stabilizers, although they are already very powerful in the EU area, maybe we would not need coordination, fully fledged coordination. In my view, the coordination can come quite naturally in exceptional times where the spillovers are obvious to everybody. So maybe we could run with some better rules and the escape clause with ad hoc coordination, because as said by Olivier Blanchard and Jeroen Zettelmeier, you cannot write down all the circumstances that can come along. So you will always need some discretion. And what we need to do is to leave the government with their responsibilities in normal times, and in exceptional times to have some ad hoc coordination. But this is difficult to write down in a kind of table. Thank you.
Let me, before I give the word to Giancarlo, say, please, the audience can always put questions in the chat, and I will then call on you later to say it in words once we open the mics. But for now, Giancarlo, please go ahead and reply to the comments briefly.
Yeah, we'll try to be brief. We can have a discussion. As Elga said, this report the fruit of a very intense debate, and I'm very pleased to see the excellent comments that we got today reflect many of the debates that we have also internally, and in a way the whole point of the report was to stimulate the debate. So despite the fact, with Charles Wyplosz, we always debated vehemently, even when we share exactly the same opinion. This time, maybe I'm old, I completely agree with what he said, so I don't have anything to say or to add. But not because I disagree with Dirk or Olivier, just because I think they raise questions important, maybe they need also our points of view. So one of the lessons from the classics is that you need to have as many instruments as possible and keep them in shape, meaning independent and actable and there. So this is why we look at the aggregate demand side of it, because it is clear that many shocks are supply. COVID is one. But it's so clear that one of the lessons from the classic is that when you don't have the instruments independent and active there, something bad can happen. And what we call tail risk is exactly this implosion, financial and income implosion that create a problem. This was very well put by Charles, by the way. So the reason why we look at aggregate demand, again, not because we are unaware of the rest, but because this is the risk that we see. And in this sense, a low R star we see as, an environment that's sort of, conducive to this risk, because it creates a constraint on a conventional monetary policy. So the whole point of going back to the middle of the road is actually this one. We would like to activate the most important instrument monetary policy that we are sort of put in the freezer for now many years. So how do we do that? So and going back to Olivier, I think that the problem is not only how to stop the dance, but also how together. I mean, the European Monetary Union had a problem. We are not dancing together. We didn't dance together in the future. It's easier not to dance together, except for the reason of coordination and special. So I agree with everything Olivier said, except that I think maybe it would be good to bring in also the dancing together. And in this sense, we need to be careful here. The report is not advocating coordination. The report is stressing complementarity. Complementarity, again, is not an aspect, it's a matter of fact. The fact that, when you lower interest rate, you create room for fiscal policy. Certain fiscal policy help monetary policy, like avoiding a very low R star, for example. So this is a fact that we can either recognize or ignore. The cost of ignoring is dangerous because it's 2011, 2012 in Europe. And other examples of that. This is my amazing. So, and I finish with, so of course it's not easy how to create an institutional framework where, with all our skepticism on fiscal policy, this miracle can happen. But I mean, here is really, we're talking about the survival of, the way we run economies as we know, right? As we know. So coming to the last bit is that the report is actually extremely sympathetic to reform policies, taxation. We don't think that R star is really a matter of monetary policy only. But there is also a sense in which whatever reform, you will need to avoid an implosion of aggregate demand, and you want to help the reform going with supporting the reform with aggregate demand. So it's I would avoid the separation principle, at this point, because this is not a world of separation. Tail risk is a world of high risks, and the separation principle is risky. You cannot think of reform or R star, and then whatever is left for. And I want to stop with one question. There is a thesis that tells us, with good evidence, that maybe a low R star is also linked to a shortage of safe asset. Now, are we sure that the problem of Europe is to convince people to go into risky asset, suffering a shortage of safe asset, or rather the problem of Europe is to create enough safe asset as people rightly so want, because pension rights are under stress, because access to goods are under stress. So I think this is not right. We want capital market union, but we can, sort of think, go ahead saying that for the next 10 years, a lower star will be a given, or safe asset will be a given, a declining investment will be a given. We cannot take this as given. How do we get out of it is a problem, but I think at least asking the question is the right first step to take. I stop here, sorry for taking time. But by the way, thank you for your comments, because as I told you, we discuss many aspects. The more questions, the better for us to articulate what we want to say.
Thanks very much, Giancarlo. There is a question in the chat by somebody whose alias is Mon Paris. Would you like to open your mic and ask that question in person?
Yes, hello everybody. Paola Monperus Veroni from Crédit Agricole. My question is, if you don't think that the Federal Reserve and the ECB have already missed the opportunity in their strategy reviews by not clearly assessing the question of the fundamentals of our stars and how to fundamentally address this question, other than simply by talking about inflation targeting.
Thank you very much. Perhaps one of the authors can take the lead, and then I'm happy for you to just exchange the mic.
I think for the ECB, we still are going to see the grand revelation later this year about what the strategy review will entail. My impression is that it will be much broader than for the Federal Reserve. Because sort of the remit of questions that are being looked at and are being discussed is much wider than what the Federal Reserve did, which clearly focused very much on its inflation target, and now has adopted flexible average inflation targeting, which is, a serious commitment to make good for the undershoots in inflation. So that would help to anchor inflation expectations more firmly around the target. But importantly, the Federal Reserve has also told us that they are going forward no longer going to be worried about having the economy, or more specifically, the labor market, run too hot. Right? They are now saying that they only take into consideration any shortfalls from full employment. So there's an asymmetry in this. And both of these crucial steps, I think, will mean that in the coming years, the Federal Reserve is a lot more inflation tolerant than it would have been in the past. And that is interestingly maybe similar in terms of sort of mindset and attitude to what we saw from the Federal Reserve in the second half of the 1960s. So I think for the ECB, it's too early to say. I think it's broader. And you can also sort of already pick up that there is a discussion around sort of the fiscal policy coordination and rules within the euro area. So I think here the mold hasn't been set yet.
If I might add a word, I think the ECB has already played the role of coordination device for fiscal policies, actually. We've said that there are 19 different governments, but the ECB has offered a window of opportunity for extremely expansionary fiscal policies all around the EU area. So in a sense, the ECB has, well, in this tail risk, I'm not talking about pre-crisis, although also Draghi repeatedly said that he was expecting more fiscal policy, but here we clearly have an example where the ECB plays its leading role in the game with fiscal policy.
Maybe if you allow me just a remark, just to say that for central banks, except if you buy the argument of Borio, which was mentioned by Charles, our star is not a responsibility per se of the central bank. So the objective of strategic review is rather how to implement monetary policy in a world of low R-star. It's not how to change R-star. It's not, as I said before, the low R-star, the main factors behind the low R-stars are structural. They are not monetary.
That's true. That's true. We would say it otherwise.
Excuse me, there is a question that seems to take issue with this view that R-star is not for central banks to influence, and namely it's about what kind of assets central banks should buy and whether the fiscal policy should also change the structure of its expenditure mix in order to raise long-term interest rates. So the question is, should the central bank only buy government bonds that fund productive investments such as green bonds, infrastructure bonds, and thereby, that's my interpretation, contribute to raising R-star?
May I disagree with Olivier Garnier? Saying that R-star is not a monetary policy issue may be an easy way for central banks not to take responsibility for something that they may have created. That was the meaning of my argument, and let me just restate it in one sentence. When central banks spend a decade keeping interest rates very low, and yet they don't manage to raise demand, and so actual interest rates are extremely low. Any of the techniques that people use to measure R-star will tell you that R-star is very low. Now imagine the interest rates, say, to 2%, and it has no effect on demand, which is a possibility. Then the same technique will say, oh, R-star has increased to 2%. We don't know. There's enormous amount of uncertainty about what is R-star, but I'm not completely reassured when central banks tell us so. None of my problem.
Okay, thank you. Thank you very much. There is just a new question in the chat by Olivier Bond, my colleague here at the Chair from the Banque de France side. The report rightly puts emphasis on tail risk. Or I should ask Olivier, would you like to ask your question in person? I shall ask the question for you then. The report rightly puts emphasis on tail risks. No, go ahead, Olivier, go ahead. But you need to unmute yourself first.
Okay.
Yes.
Okay, thank you. Just have a questions. I mean, there is a lot of emphasis in the report on tail risk, and of course there is a related concept, which is the uncertainty. Of course, uncertainty and tail risk are somewhat related. And they currently, I mean, all the discussion that we have to some extent connected to the issue of increasing savings, with the excess savings, worldwide. So how do you see this as, of course, an effect on the policy mix? So what is your view about how should we proceed on this new uncertain environment, which is certainly a very important dimension of nowadays macro discussions?
Shall I give this a try? So I think this is actually at the heart of the issue, and also of how sort of the policy mix potentially has an impact on R-star over the long run. Because if we have no credible way of dealing with some tail events, this will likely bolster the precautionary savings motive. So people just save more. And on top of that, if due to the tail events, you have more volatility in financial markets than you would otherwise, you not only want to save more, you also will want to allocate a greater proportion into safe assets, i.e. government bonds. And that's sort of where the connection is. So it's not monetary policy's job to fix R-star. There are, as Olivier Garnier said, a lot of other important drivers. But I do think that the demand stabilization policies have a really important role to play, because they need to nip into the bud the tail risks, because otherwise the expectations of their existence and the fact that we have maybe even instabilities, multiple equilibria and so on, will have pretty serious repercussions. And then if you add on top sort of the chipping away at inflation expectations with prolonged undershoots of the inflation target, then it's sort of, you get set into motion a development where monetary policy space gets more and more constricted. And so that's where the connection is, and I think it's indeed via those tail risks. It's not the only reason that drives the precautionary savings motive or the safe asset premium, but it could potentially be an important one.
Let me give the floor to Giancarlo, who raised his hand. I'm happy to run over time for a minute or so, but it's almost out of time now. So Giancarlo, please, the final word.
I actually don't have much to add to Elga, but I just want to make a remark. There are different views about our star, and in a way, you know, like Charles is reporting one, there is the secular stagnation view, lots of structural factors. All we are saying is the fact that at this stage, it looks like we are rethinking our instruments ahead, denying that there is something to be attempted there, which I think is a dangerous walk path. It's just a dangerous walk. So, as Elga said, you know, there is a serious question of why an aging society should not spur investment, given the fact that the structure of demand change with the society, and there is more, request maybe for automatization. Why climate change should not spur? And this is, I'm saying this because clearly everything we say does not deny all the reason to be skeptical about fiscal and monetary policy in the past, right? You're very clear in the paper. There is procyclicality, the electoral cycle, all that is there. There is issue procurement, open issue of private-public partnership. All that is there. The COVID crisis does not cancel the problems, right? It creates, however, a sense of urgency and coordinate, or better, push the different instruments together in the same direction. This is, in a way, we try to say, to argue that maybe even across borders, there could be an awareness that this is maybe the time to attempt something, to see what the way forward would be. Having said so, it's clear that it would become a clear, not only for one central bank to have a solution for, but even for a country to have a solution for a star. At this point, it's more of a global than a particular national issue.
Thank you. I think these were perfect closing remarks. We are running out of time, unfortunately. I think there are many exciting questions and topics left for discussion, which I hope we can continue in some other format after this event. Let me close today's policy panel by thanking again our 6 participants for their contribution. Also thanking the audience for taking time for the great questions. I would also like to thank our communications team, Samuel and Julia, for all the help for setting this up. And of course, we'd be happy to welcome, hopefully many of you, to other events organized by the Chair Banque de France in the future. In the meantime, stay healthy. Thank you, and goodbye for now.